right, Lundy Wright, known as the Bond Guru, wise mutual multi-strategy advisors. So good to have you on, Lundy.
Great to be here. Thanks a lot for having me.
So, Lundy, what's on your mind? You know, we talked before we hit the record button about the affordability crisis, which is big. The Federal Reserve government supply and demand side. So, like, what's really kind of keeping you awake during the night these days?
Well, there's a number of things going on right now that haven't gone on for the previous decade. When we were at zero rates in government bonds around the world, or negative rates, there was a much different a list of things to focus on than what we have now. And now that we have rates back up to the highs of the past decade, or more into the zone of where we were pre-zero rate regime, we have a number of things. And one of the main things that is of a focus is the amount of supply coming in government bonds and the demand for government bonds as well. So we have GDP growing, we have full employment, and yet the deficits are still growing. It's a very unusual trifecta, because typically when GDP grows and you're at full employment, your tax base is improving and your deficits are declining. But that's not what's happening right now, and that's a disturbing trend that everyone's dealing with, and particularly in the United States. The interest expense is growing so rapidly. I think it was 2%. It was forecast to be 2% of GDP this year, or last year. It's expected to be 4% of GDP in 7 years. So wow, that's just the interest expense alone. The actual deficit itself is going to be 1.7 trillion next year, 1.9 the year after is what's forecast. And as a percentage of GDP, the forecasts are going something to the tune of from 96% to 123% over the next decade, with no end in sight. And this is where at some point the fiscal situation has to be altered. And it's not really I'm not here to blame a specific political party, since it's been constantly growing, but it has exploded in recent times. And some of that was a reaction to COVID. Some of it was a reaction to control of government afterwards, and a lot of pressure to get a lot of things funded that were long sought after. And I think that the hard realities of being indebted and having to choose down the road of, do we pay our interest, which you have to, our interest expense, or do we have to shrink our military budget, or do we have to shrink our education budget? And so these are the types of crowding out battles that will occur, and they're not going to be fun battles. So that sort of that dynamic brings tons of supply into the marketplace, government supply, because to fund the government's activities, they have to increase the supply dramatically. And it's in the next year and a half, it's going up a lot, and likely to continue to go up for even further. On top of that, demand is lessening. And by demand, quantitative tightening is a reduction in demand. Because if you build up your balance sheet to 9 trillion, and then you are intending to shrink it to, say, 6 trillion over a couple of years, that means you don't keep buying more treasuries in the marketplace to keep it at 9 trillion. As your existing holdings mature, you get coupon payments and whatnot, drawing it down. So they are drawing that down. So who's buying that extra 3 trillion over a couple of years? That is demand that's lessening. Foreign official institutions, so many countries find themselves in a very similar situation, that foreign official institutions are either trying to sell treasuries to finance intervention, or they have their own problems themselves. Pensions are starting to strip, are slowing their stripping, which is demand for long bonds. Money managers got fully long after SVB because they all thought we'd have a recession. And so with SVB, they said, "Oh, banking crisis and recession." They got fully long at like a 3.5% more, a 3.5% yield on, say, 5 and 10s. And now they're 100 basis points or so underwater. And with that, they're holding on, but they're not adding at this point. And
so who's going to buy?
That is the question. And, CTAs are very short. The hope right now for the immediate is that they buy, and hedge funds, but that's not a long lasting buyer. And so as a result of the answer to your question is yields should go higher. You hear the government and Fed officials and such talk about it as the term premium. It's where would you buy the next trillion? You demand a greater yield to take down the greater supply. And as that happens, and it can happen quickly, it can happen slowly, depends what else is going on. But as that happens, that it's almost like water dripping in a tub that's stopped, and it could drip for a long time until it starts to overflow, and then it starts to become a problem. And so it's go ahead.
Is that like, you're flattening the curve, and or I heard you saying like, you're normalizing the curve.
Mm-hmm. Yeah, and I think normalizing a curve is a very good thing. I think there's a bit of a mistake. I think there's a political convenience right now for Fed officials to say, by normalizing the curve, and by that I mean taking it from being inverted to being where every point on the yield curve is effectively the same yield. So it's a flat curve, and then if it starts to steepen, that's a normal curve over history. So as they move that back, you've heard Fed officials say, well, the long end going higher in yield is doing some of our tightening work for us. And yes, higher yields will ultimately slow the economy. No matter where they occur, they will work against that. But it is we're not going to higher yields because the Fed is engineering it, as much as we're going to higher yields because people are demanding higher yields to buy it. And so that sort of curve normalization, I think, is a very good positive for what is ultimately the effectiveness of Fed funds. The Fed funds changes in the Fed funds for the central bank to control monetary policy. So as an example, when they raised rates 500 basis points and the 10-year note only went up 200 at first, well, they didn't get the same amount of tightening and restrictiveness into the marketplace as they might have had they not done QE, quantitative easing, because there was still a lot of demand for long end assets, but there wasn't the float out there. When you're doing quantitative easing, you're taking the float out of big parts of the curve. So it's manipulated. It's not responding to just market conditions. It is actually being, by the central bank, by them buying it specifically, it is not really yield curve control, but it's sort of yield curve control light, if you will, because you're artificially suppressing between zero rates and buying the assets yourself. You're suppressing the yields. And then when you try to back it off, well, it just doesn't snap right away, because the people who would maybe want to sell those bonds don't own them. They'd have to short them. You see this happen in Japan again and again, right? They back off yield curve and everybody gets short thinking they're going to make a lot of money. But then nobody owns the bonds but the government. And if the government doesn't sell them to them, then they buy them back for each other. You have a short covering rally. So it's the same type of dynamic. It takes time, but We're now getting back to where we're close to having a flat curve. And in that, then at that point, I think monetary policy picks up its effectiveness, because should the Fed tighten again, you would imagine more of a parallel shift in the curve, as opposed to just the front end going higher in yield and the back end not moving. In fact, the back end was going lower in yield when that was happening. The flip side is when the Fed eases, you would imagine everything can rally. If the bond was stuck at 2.5% and the funds rate's at 5.5%, if the Fed eases, the bond might not rally. It might actually go higher in yield, depending on what inflation is. So I think a normalized curve is it's a good positive for the future in terms of the Fed being able to impact what restrictiveness or stimulus into the economy, because the transmission mechanism of their intentions will be more historically accurate, more genuine. It'll be the reactiveness of what they do will have more bang to it, I think.
But then you mentioned, and please correct me if I'm wrong, that right now, I mean, the whole purpose of tightening is to to a certain extent slow the economy, and to kind of balance the economy. So this doesn't seem to work in your opinion, and it also relates to the how assets are distributed, obviously. So can you elaborate a little bit?
Yeah, definitely. When we were at zero rates, before the Fed started to tighten, just to simplify the argument so it's clear, let's say 2/3 of the United States took their debt and they termed it out for 30 years with a 2.5% mortgage.
Right.
So let's just simplify and pretend everybody did that, or 2/3 of the economy, the people who owned homes, say, or half to 2/3 did that. Well, now when you raise rate, and for 10 years, if I had savings, part of putting zero rates and then quantitative easing is forcing me to move into more risky assets to get any return. Because if I put my savings in, say, T-bills, I made nothing for 10 years. So now I'm fully termed out on my debt. And then the Fed raises rates by 550 basis points. Well, once it's there, did that impact my debt? No. In fact, I'm still sitting in my 2.5% mortgage for the next 28.5 years. But now my savings makes 5%. In a way, they've improved my personal economic situation. Even though they've tightened, for the short term, I'm more wealthy. My home price hasn't gone down. In fact, it's gone up. Stocks have basically gone sideways to up, depending on your time zone. And now I can take my savings and make 5.5% on them, whereas for a decade I made 0. At the same time, they raise rates another 50 basis points. It's not changing my cost of my cost of capital as a person. So in that environment, it is squeezing the people who don't own, who don't have long-term locked up debt. It's squeezing the people who are living on monthly loans or very short-term rollover loans. And eventually higher rates will slow the economy because any new endeavors have to pay a lot more to finance it. As you roll over your debts over time, that jump in cost. And so that happens over time. But that doesn't happen in the first year, typically, maybe. And because of long-term debts, it might be a number of years. And I think that dynamic, the mirror image of it will happen if they ease. Let's just say they ease from 5.5% to 4%. They ease 150 basis points. Everybody go out and spend. All they've done is reduce my savings income. My debt is still at 2.5%. So am I going to go refinance now? Probably not, unless I wanted to move anyway. But there becomes a lot of frictions in there as a result, because you have people who bought a starter home, and now they've had, in the last few years, they've had an extra kid or two, and now they want their starter home became a forever home, and it's kind of tight. Or, so they've wanted to move, but it's hard to move with the higher interest costs. And at the same time, you have to refinance to get the equity out of your house that you have. And that's expensive too. And some people simply can't qualify. Other people who can qualify, they move around for so many reasons. I think I traded mortgages for a number of years, and it used to be that the average homeowner would sit in a home for around 7 to 10 years. And I'm guessing that's probably still the same, but with COVID, because nobody moved for a few years, it might be a little bit extended at this point. But you have that dynamic that I'm talking about is this has impacted the Fed's ability to have immediate effectiveness with changes in monetary policy.
And could you say, the higher the wealth gap between the asset owners and the people that don't have assets and have to do like short-term financing, and like the bigger this dynamic is, pretty much, right? I mean,
absolutely. Here's a couple stats that are, some of them are well known and some of them aren't, but it used to be a rule of thumb when you bought a house that 25% of your income would go to paying your housing costs. Then it drifted to 30%. Well, now it's 44%. And in some cities in the US, it's over 90%, which is nuts. But this is dual income too. So everybody is basically using their income to pay for their house. Now, depending on your work line of work, your income might be different than your total compensation, right? And so people might be using your income metrics, but not your total compensation metrics. But still, if it's 44%, housing is now the least affordable it's ever been in the US. And because during the great financial crisis, all the millennials, there's a ton of household formation that was delayed that is still pent up. And now if you're 30, if you're 25 to 40 and you haven't bought a house, you've missed out on a wealth gap, because whoever did own a house, to simplify it yet again, if they bought a $500,000 house, it might be worth $800,000 now. And so that person is sitting on a equity nest egg, and the person who was renting missed out completely. And so in terms of that gap, there's other assets too. Like autos are completely unaffordable. I heard this auto economist, and he had a lot of great stats. And he was saying that half the people can't afford a monthly payment over $400. Since 2019, used car prices are up 45%, and your lease payments are three times higher. And so there's a lot of these types of imbalances, if you will, that are going to take a while to get worked out. But for right now, the wealth gap got much, much bigger in the last number of years. And the difference between inflation and affordability is an important point, because
a lot of people get this wrong. A lot of happy commentators,
they conflate them all the time. And so what you have is these commentators go, well, inflation's only up 4% this year, or only up 3% this year. The Fed's doing great. And so that's good for the consumer. Yeah, but if I couldn't afford a house last year, I'm not going to be able to afford one this year. It jumps so high in value. Housing is still at all-time unaffordability levels, even though inflation's come down. So it's one of those situations that people think will correct itself. I think as long as people have jobs, it's going to take a very long time to correct itself. On top of that, the boomers, the baby boomers, the windfall they had as they were getting ready or to retire or just retire from their primary, for many of them, their primary asset, their house, to go up so much in value. And then they sold it and moved to a much less expensive state. Like they sold it and moved to Texas. And so they moved from New York to Texas, and now their cost of living's down. They took the money out, and those boomers are spending a lot of money. And it's their net worth since 2000, since the start of COVID, is up by something like $18.5 trillion. And, you know, you can't take it with you. So they're spending it. They're taking their extended families on trips. There's a lot of things that have changed for them. And on their savings, they're now earning 5% instead of nothing. So it's their wealth has exploded in just the last number of years. What's important in all this is the government, with all the fiscal spending and the handouts and the different things that were going on, the consumer is in good shape for the most part. And that's in part why the government is not, because the government wrote trillions and trillions of checks and gave them to people. And now the government's trying to fund all those trillions and trillions of dollars that they gave away. Meantime, initially, all the credit data was greatly improved for consumers, and now it's starting to work its way back. And it's the lower quintiles that are really feeling the stress. You know, if you, and even the people who reached when they bought a house, you know, if you bought your house and you reached for it just a little bit, and most people, when they buy a house, they have an idea of what their monthly costs or quarterly costs will be. Can I afford to own that house? And since they moved into it, they might have a nest egg that is difficult to access without refinancing, but they're almost house poor, some people, because their taxes went up, their insurance costs went up, their maintenance costs went up, their utilities went up. They've been squeezed on every level. And all of that sort of dynamic, there's a lot of imbalances right now in the system, but in general, it's the real risk is that right now is at the federal level, because they transferred wealth to the consumer, bailing out the consumer, and the consumer has been living off those excess savings that they've been calling it for the last number of years.
And if you are since you're a betting man, like when you look at, you know, the next 5 years or so, right? Like, where do you see this going? Because, you know, okay, so probably fiscal is going to be continued. You want to attract manufacturing back, you know, friendshoring, offshoring, nearshoring, whatever it is, right? So it's probably not gonna stop, because you need to be, you know, keep people employed. Right.
Yeah.
And that's not even, you know, a lot.
And I think keeping people employed is the key. If we have a catalyst that starts to lay off people, and I will argue that artificial intelligence is a potential catalyst. If we have a catalyst that starts to lay off people, that is where you're going to get the imbalances become even greater political issues than they will be in the next year. And so, because it's a political year, you know, for a presidential election in the United States, there will be a lot of politicians who will grab this concept and run with it, about how people have been left behind, and you're going to get calls for greater taxes and some level of redistribution. And there will certainly be many of those arguments that are sound or worthwhile, worth considering and worth evaluating. But there will also be many that will just are barked out in order to try to garner votes, whether or not even though it'll never happen. And it's part of the problem with the whole MMT logic, in my opinion, is that it ignores human nature. MMT logic. So MMT was basically, and I'm sure MMT experts would tell me I'm wrong, but it's basically you spend a lot of money, and when you need to, when you start to get inflation, and you have problems, then you raise taxes, you reduce spending. Problem with human nature is nobody ever wants to go the austerity route. It's everybody always,
people don't like pain.
Not at all. They won't vote for it. And so and yet that is what needs to happen, in my opinion. And so if in some level, and it's probably going to be in a lot of levels, I expect taxes will go higher. In which way this works out, I don't know, but taxes will go higher, spending will get cut. And in a weird way, or a perverse way, the interest expense will force some of these difficult decisions. And so the interest expense that will force some of these decisions will create away from the interest expense for the rest of the pie. It will create a difficulty to expand that pie. And so away from interest expense, if rates go back down quickly, that exercise of not expanding healthcare, education, military, whatever you're looking at, whatever line item you're looking at, that exercise would be already underway, I think. So in some ways, I think a lot of people in the markets are so eager to welcome lower interest rates. And it's been this way from the day the Fed tightened the first tightening to a year and a half ago. Every single tightening was, well, that's the last one. The Fed's going to pivot. And you could just hit replay every Fed meeting, hit repeat. It's the same rap.
Well, a whole generation doesn't know any better, right? Like a whole generation of people in finance, right? So
yeah. And to be fair, like you said, they don't know any better. The Fed, that's been the solution has always been to spend more money for the government to spend more and for the Fed to cut rates. And the problem is, over decades, that solution has become the problem. And so now every time, if you just give away money again, we're going to get inflation. If you give away money and lower rates to zero again, we're going to be back in this inflation problem. So the Fed, it's really interesting that people will sit here and say, well, what got us into this problem was free money and way too much fiscal spending. And then you talk to them, you'll say, well, what has to happen if the economy slows? Well, we got to lower the cost of money and give more out. It's literally, it's a very difficult thing to have a conversation on, because it's almost like a year ago, Howell said, everyone's going to feel pain. No one's felt pain. And until they do, it won't matter.
Before we wrap this up, Lundy, like, are there any interesting, data points that you're watching that you think are really kind of, insightful to, have a gauge on the employment situation, or any kind of, leading indicator that tells you, okay, watch out for this?
Well, claims has been the best. I think the most critical employment indicator will be job indicators. Claims has been the gold standard for leading indicators of the jobs market for a long time. Claims has not been a reliable indicator over the past year, maybe, because there's been many different fraud instances at different states that have spiked the claims. And for that reason, it's been hard to read. Back in, I think it was June, July, and the claims got to the 260s. It might have hit 270. And when that was happening, everyone was saying, we're going to a recession. See, when claims go up 60 points out from their low, I forget what the rule of thumb is, but it's something like if claims go up 60 points from their low, that has always led to a recession. So people were embracing that. But something like 35,000 of those claims were fraudulent. And they were moving from state to state, and it was taking claims offices months to figure it out. And they were doing things, as I understand it, like creating a fake company, having fake employees, firing fake employees. Those fake employees then make unemployment claims. And just because you filed a claim doesn't mean you actually collected money, but they were trying to do that. But if you file a claim, that's what gets recorded into the data. And so certainly in Massachusetts, Minnesota, Ohio, Texas, California, New York, over the last couple of years, there's been a lot of fraud. And so, excuse me, assuming claims can corral the fraudulent activity and put an end to it, then claims is absolutely what you need to look at first. And so right now, claims is might be a little impacted this week on because of the strike. Maybe 5% of the move could be, but once we get through the strike, if it's still in the low 200s, that's a very good sign for the employment outlook.
Interesting. Lundy, if people want to follow your work, like on Twitter, website, etc., like where can they find you apart from us?
I am on I do have a Twitter. It's L Wright at Weiss. And our firm has a number of people who put out tweets. I'm on I'm on LinkedIn, and even though I am not always so responsive on those sites, sometimes I am, and it really depends on my focus. Sometimes someone will say to me, I have heard your stuff and I want to, open up a line of communication, and I miss it. I just don't see it. And it happens. And it's happened to me where, a guy who I grew up with, and I wasn't friends with him growing up, but he grew up in my neighborhood, and
right.
And I had no idea that he had reached out. And then I heard through another friend, this person reached out, and so it does slip through, but that is how to reach me.
Okay, fantastic. It's been a pleasure. Lundy, thank you so much.
Armand, thanks for having me, and it's been a pleasure being here.
Cheers.